Welcome to the Two-Handed Economist. I'm John Diamond from Rice University's Baker Institute. This show gives you what a one-handed economist can't, both sides of the argument. We're not here to repeat sound bites. We're here to give you the full picture. Today is Wednesday, October 29th, the 29th day of the U.S. government shutdown, and the pain is spreading. Federal employees are missing paychecks, flight delays are spiking, and SNAP benefits could dry up by November 1st. Meanwhile, the labor market is weakening as AI is starting to devour white-collar jobs, but the stock market is booming. On the monetary side, the Fed has just cut rates again by 1/4 point, with inflation stuck at 3%, and repo markets are signaling that liquidity issues are possible. Finally, President Trump prepares to meet Xi Jinping, the president of China, to hash out a possible trade framework between the U.S. and China. Soybeans, semiconductors, and rare earths are on the table. Welcome to October 2025, where every economic headline is truly spooky. Let's dig right in. The government shutdown is alive and kicking and approaching 30 days. It's already the second longest shutdown on record and is only 6 days away from being the longest. As of today, the shutdown has reached day 29 with no resolution in sight. Agencies are closed, essential staff are working, non-essential staff are furloughed. None are getting paid. Businesses with government contracts are starting to feel the pain, and the economic and political costs are mounting. Over 700,000 federal employees have been furloughed, with nearly as many working but not getting paid. They've almost missed a month of wages at this point. CBO estimates that furloughed workers will miss roughly $400 million per day in lost compensation. Transportation Secretary Sean Duffy told reporters that before the shutdown, staffing shortfalls were responsible for roughly 5% of flight delays, and that now that number is over 50%. If you're waiting for your next flight, you're likely feeling the shutdown. Maybe find some solace in the fact that you are getting paid. What's the political risk? When federal employees miss one paycheck, the pressure builds. Miss two, and the level of anguish increases. And this can turn into a fiscal policy crisis rather quickly if left unresolved. The latest news is that food assistance programs like SNAP, the Supplemental Nutrition Assistance Program, will be cut beginning in November because of the funding lack. Because of this, more than 40 million low-income families will see reduced benefit. The American Federation of Government Employees is urging Congress to pass a clean, continuing resolution. I agree. Using the shutdown to force political action on a policy decision is wrong. Democrats passed the provision as a temporary policy, even when they controlled the presidency, the Senate, and the House. It's wrong now to hold the country hostage and demand the provision be extended. President Obama once said, "Elections have consequences." Senator Amy Klobuchar may have given the best example for why we should have a debate instead of taking hostages. In a recent social media post, she mentioned that early retirees like Bill and Shelley, a couple she wanted to point out, will see their monthly health insurance premiums increase from $442 to $1,700. That's a lot. But the couple has an income of at least $130,000 and chose to retire early and travel. The couple says they would be rich if it were not for healthcare expenses. Note that the median U.S. household income in 2024 was $83,730. Should we really be forcing taxpayers to subsidize early retirees that make almost $50,000 more than the median household income? And what about similar households with similar incomes that are working full-time and that get health insurance through their employer? They are also seeing large premium increases. Should we increase the subsidy they get as well? There are many situations and issues we could raise in this debate. Well, that is if we had a debate. The issues deserve an honest debate and shouldn't be decided under the threat of a government shutdown. If Americans want larger subsidies for health insurance premiums, then they should let legislators know, and Congress can pass the increase by way of the regular process, not by way of force in a hostage negotiation. Switching gears, while the feds are hunkered down, the private sector is also adjusting, but in a different way. An emerging trend is companies trimming jobs, repositioning for generative AI, and reducing cost. According to the Kobesi letter, recent layoff announcements include UPS announcing 48,000 employees to be laid off, Amazon announcing 30,000, Intel 24,000, Nestle 16,000, Accenture 11,000, Ford 11,000, Novo Nordisk 9,000, Microsoft 7,000, PwC 5,600, Salesforce 4,000, Paramount 2,000, Target 1,800, Kroger 1,000, Applied Materials 1,444, and Meta 600. In addition, Chegg announced layoffs of 388 employees, 45% of their workforce. Why? Traffic and subscriber declines, blamed in part on students turning to free or low-cost AI tools instead of homework help platforms. According to Reuters, Amazon is targeting as many as 30,000 corporate job cuts, roughly 10% of their corporate headcount, as the company pivots toward AI automation and streamlining. TrueUp's tech layoff tracker shows that in 2025, there have been 585 layoffs at tech companies, affecting 176,352 people. In 2024, there were 1,115 layoffs at tech companies, with over 230,000 people impacted. This isn't just a slowdown, it's a structural shift plus a slowdown. AI is reshaping the workplace, automating routine tasks, rewriting how content is created, and making old systems obsolete. This has seismic implications for the labor markets, regional economies, and corporate earnings. Layoffs across industries are mostly related to one of two economic events. Some indicate that companies are restructuring to increase productivity by adopting new technologies. But for some, it may reflect cost-cutting to deal with declining profit margins, which for many are the result of increased tariffs and broken supply chains. Either way, the labor market is shedding workers because of a mix of structural and cyclical shifts. The big question is, what impact will this have on the consumer? Consumer spending is the backbone of the U.S. economy. If a weak labor market slows consumer spending growth, then we could finally see the recession that many have predicted for each of the last 2 years. Now let's turn to the Fed. If the economy is slowing, then the Fed has some big decisions to make. The Federal Open Market Committee reduced rates by another 25 basis points today. The market's fully expected the Fed to cut rates by 25 basis points. This is despite inflation data for September that came in at 3% year over year, which is up from the 2.9% year over year number in August, but still less than the expected increase of 3.1%. Core inflation also sits at 3% year over year. The Fed's target is 2%, so 3% isn't mission accomplished on the inflation front. But labor market conditions require actions. But as I stated previously, it's not clear that small reduction in the Fed funds rate will help a labor market in the midst of a structural shift, or one that is being impacted by the uncertainty of tariff and economic policy. Meanwhile, the Fed has been shrinking its balance sheet and managing repo market pressures. The repo market is an indicator, or can be an indicator, of liquidity tightness in the banking system. The Fed will stop reducing its balance sheet soon. In a recent speech, Federal Reserve Chair Jerome Powell stated that some signs have begun to emerge that liquidity conditions are gradually tightening, including a general firming of repo rates. The spread between the secured overnight financing rate, the SOFR, or the repo rate, and the federal funds effective rate is one signal of funding stress. This is something the Fed must continue to watch closely. Regardless, the Fed is most worried about the labor market losing momentum, and the signs from the labor market give the Fed a lot to worry about. Finally, let's talk trade. According to the United States Trade Representative, President Trump signed agreements on reciprocal trade with Malaysia and Cambodia and reached frameworks for agreements on reciprocal trade with Thailand and Vietnam. Under the new trade agreements, the United States will impose a 19% tariff on exports from all three countries, with tariffs on selected goods set to fall to zero. A similar framework is being negotiated with Vietnam at a 20% tariff rate. Vietnam, which ran a $123 billion trade surplus with the U.S. last year, has pledged to expand its purchases of U.S. goods to narrow the trade gap. More importantly, it was reported that Malaysia agreed to allow unfettered trade of critical minerals and rare earth elements with the U.S. This is an important deal given that Donald Trump is set to meet with China's president. And one of the big issues is the discussion of China's export controls on rare earths. Reports suggest a framework deal with China might include China committing to large purchases of U.S. soybeans and relaxing export controls on rare earths, and the U.S. easing restrictions on high-end semiconductor chips flowing to China and reducing tariffs imposed on Chinese imports into the U.S. The deal matters because it could ease pressure on U.S. farmers, reshape global supply chains for chips and rare earths, and reduce pricing pressures on consumer prices if tariff relief is included. Politically, it gives Trump a headline win at home, but ultimately the value of these deals depend on how long they are sustained. The on-again, off-again trade policies of the Trump administration have been a drag on the U.S. economy, and what we need in the near term is certainty. While lower tariff rates are important for future economic growth, that's right, I don't buy the Trump argument that tariffs will make us rich. I believe high tariffs will be a drag on economic growth. Stability and certainty are what's needed in the near term. So here's what to take away from this week. The government shutdown is no longer a policy debate. It's an economic tax on ordinary Americans. Each day that passes without a funding bill erodes public trust, slows growth, and deepens cynicism about Washington's ability to govern. Using the shutdown as leverage in unrelated policy fights turns fiscal policy into political hostage-taking. If Congress wants to debate health subsidies or budget priorities, it should do so in the open, and it should do so now, after we pass a clean, continuing resolution. The longer this drags on, the more the political cost will outweigh any policy gains. Meanwhile, the labor market is sending a different kind of warning. Layoffs are piling up, not because the business cycle turned south, but because technology is rewriting the rules. Companies are cutting costs and jobs, not just to survive, but to reinvent, betting they can do more with less through AI and automation. That means even as the Fed cuts rates, monetary policy may have less power to stimulate hiring if the slowdown is structural, not cyclical. The next real test will come when weaker consumer spending meets a workforce still adjusting to this new, leaner economy. And third, finally on trade, the White House is busy signing and announcing new deals across Asia, from Malaysia to South Korea to possibly China. But the real challenge isn't striking deals, it's keeping them. Global supply chains need predictability more than they need headlines. If the administration can deliver stability, not just tariff cuts, that alone can support investment, reduced inflation pressures, and rebuild confidence. For now, the world is watching whether these agreements mark the start of a more stable trading regime or just another round of short-term bargaining. That's it for this week's episode of The Two-Handed Economist. Thanks for tuning in. The Two-Handed Economist is a production of the Baker Institute for Public Policy, recorded on the campus of Rice University in Houston, Texas. Production support was provided by Shannon Moriarty and Karina Zimmel. You can access show notes and other podcasts from the Baker Institute at bakerinstitute.org/podcast. If you like what you hear, leave us a review. It helps other listeners find the show. Until next time.